Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing well. How about yourself?
Good, thank you. Well, it looks like we're going to talk a little bit about 2018. The last couple of shows, we talked about volatility in 2018. What we're going to talk about today is, how should your investment portfolio be positioned in 2018? And we bring that up as a topic because we hear from a lot of clients and people in the news talking about 2017 was very unusual because the market continued to climb. 2018 is a little bit more the norm and unfortunately makes us feel a little bit uncomfortable with the volatility in the market. But really, when it comes down to looking at 2018, we'll look at some very basic items that you should be looking at as far as how your portfolio should be constructed. And also, we're going to look at some economic conditions that, if they go forward, could be very, very favorable yet for 2018 and the stock market. So, again, let's look back at 2017 for a minute. Last year, stocks gained at about 22%, and we're talking about the S&P here, so which is more than double the historic average. That's very important, again, because it seems to be that a lot of folks think that today, 2018, is out of the norm. It isn't. We're seeing that volatility, which is actually pretty common outside of 2017. Tyler, what else, should we be talking about when, we're looking at a portfolio in 2018, and what are the numbers that lead us to it?
Yeah, Dean, and since the beginning of 2009, stocks have gained an annualized rate of return of 15%. So since the beginning of 2009, that was when the market bottomed out after the recession. Then they gained an average of 15% per year over the last 9 years. So again, that's a pretty hefty number. And I think a lot of investors are caught up on that, where they've seen the returns. We've been in a huge bull market here, and things seem to be pretty rosy. But however, as we've seen just within the last couple of weeks, within the last couple of months of 2018, we're now beginning to see that major volatility, and that's based on a number of different things, such as potential talk of interest rates, inflation, and more recently, a looming trade war with China and different trade tariffs to go along with North Korea, Russia, different things like that. So really, right now we've seen a lot of different political chatter that seems to be driving the market. One day it can be down 2%, then the next day it's up 1.5%, next day it's down 3%. So we've seen it bounce around quite a bit over the last couple months here. But with that said, 2018, like you said, Dean, that should be more of the norm, where we see the market bouncing around up and down and kind of all over the place here. And right now, from the beginning of the year till now, it's about flat. It's down slightly. So with that said, we kind of want to give our listeners a take on how their portfolio should be positioned in 2018. And keep in mind, everyone's going to be different, of course, based on your age, your time horizon, your risk tolerance, different things like that. But generally speaking, how should your portfolio be positioned in 2018 is what we're going to get after here.
Okay, the first thing I think we need to do in 2018 is we want to temper your expectations a little bit. Again, coming out of 2017, it's nice when people say I'm shooting for a 20% gain in a portfolio like I saw in my portfolio in 2017. I don't think that's realistic. I think what we need to do is temper your enthusiasm and expectations a little bit. I do believe 2018 is still going to be a positive year for most investors, but of course it depends on how your portfolio is constructed. But we expect much more volatility like we've seen right now. A lot of it is geopolitical. A lot of it has to do with chatter and noise that's happening at a political level. Economically, we're going to talk about a couple things here a little bit later that look very favorable. So let's look at tempering our expectations a little bit, but do understand that based on basics, both economically And with a number of companies reporting earnings, things look very, very favorable yet. So in a situation like this, when we want to temper our expectations, let's go back to some of the basics. You want to take some of the gains off the table. You want to build up some cash positions. You still want to carry bonds in a portfolio. In bonds, in and of themselves is a very boring topic. Most people don't like to even discuss bonds. Many people don't understand them. They can be complex to certain people. But bonds that are held in a mutual fund or an exchange-traded fund, we look at them as a shock absorber in the portfolio. Equities, which are predominantly stock positions in mutual funds and ETFs, they bounce all over the place. And what bonds do is they soften the blow when the market is jumping all over the place. They also give you an opportunity in after-hours trading. If the market goes down and you have no bonds or cash in your portfolios, you're all in the market, you go in the next day and unfortunately you're 100% exposed to the market and the volatility. If you have some cash positions there, if you have some bond positions there, you can liquidate bonds, build cash, and then wait till the market stabilizes and then go at that particular time and buy back in. So let's talk about tempering your expectations. Tyler, what else about expectations?
Yeah, Dean, so I know we've talked about this in previous shows, but when the market's been heading upward for an extended period of time, as we've seen, as I just said, from early 2009 all the way until now, investors, they often assume that it will continue. They want to see the good times roll. And really, this is where we do have to temper your expectations, because so far what we've seen in 2018, it's a lot different than this time in 2017, where the market was headed about as straight upward as it could go. And again, it gained 22% in 2017. Now in 2018, we're definitely not on that same pace. So really, and here's the other thing too. We've had clients that came into our office and, they may be in their 70s or even their early 80s. They see how well the market's doing, and they'll inquire about getting out of different types of risk managed portfolios, CDs, fixed annuities, to go all into a stock heavy portfolio, which wouldn't be in their best interest because they don't want to take that risk, but yet they think when the market's doing so well, they should be in it. However, in early 2018, we can see just how fast things change with the market, where it can take a big dip kind of out of nowhere, and now we're kind of, if they were to go into a stock-heavy portfolio, now they're playing catch-up from behind, trying to get back out of it, and just not a game that you want to play. So really, temper your expectations come 2018. That's where we want to preface this by saying that. And I have a few other statistics here. And number one being, in 2017, BlackRock, that's an investment company, they surveyed 401k participants and found that 2/3 of those who were surveyed expected double-digit returns or higher over the next decade. So from 2018 through 2028, they expect the same thing that they saw this last decade to come up in the following decade here. And 20% of those expected even better returns in the next decade than we're seeing currently right here. So as we can see by those surveys, investors right now, they have some pretty high hopes for the market. However, there's big different investment companies, mutual fund companies. For example, Vanguard, that's one of the big mutual fund companies. They offer many different 401k investments and different things like that. They estimate that U.S. stocks will gain about 3 to 5% a year over the next 10 years, with foreign stocks doing slightly better. So right there, they're not as optimistic as the average 401k participant, and they project bonds to average about 2.5 to 3.5% a year. But then again, Vanguard knows just as much as the guy down the street regarding the stock market and what's going to happen in the future. Despite them being in the business, no one knows what's going to happen tomorrow in the stock market, 5 years from now, 10 years from now. But it's important to note that a lot of different investment companies foresee the next 10 years being not as rosy as what we've seen the prior decade. So keep that in mind, temper down your expectations. And one other point I have here is that over the last 90 years, the stock market's averaged about a 10% rate of return per year. So historically speaking, that's going back almost 100 years. It's averaged about 10% per year. But over the last 5 years, the stock market has averaged almost, as we said, almost 15% per year. So again, over the last 5 years, really, we're averaging about 5% more per year than the 90-year historical average. So just keep that in mind. What we've seen recently is actually quite a bit above average. So temper your expectations heading into 2018 and thereafter, because things might not always be as good as they had been the past 5 to 10 years.
Okay, and also talking a little bit more in detail about reassessing your stock and bond mix in the portfolio. Again, 2018 is a great opportunity to take some of your gains that you received in 2017, possibly move those into cash or rebalance your portfolio. 2017, the portfolio probably got out of whack a little bit. And what I mean by that is your equity positions, stock or mutual funds or ETF that are pretty stock heavy, probably grew substantially versus your bond positions, which can be a little bit stressed at this point. Let's go back in and rebalance, bring some of those gains that you received on the equity positions back in and move them into cash, move them into bond positions, or quite possibly move them into new investments. So it's a great opportunity here. And I always tell people, remember, your portfolio on paper grows, but until you really start capturing some of your gains, it's a no growth situation. So get in there and capture some of those gains. Cash right now is very important. And when clients come in our office, they'll ask, what is the mix? What investment should I be in? And first of all, I'll ask them, what is your temperament right now? How do you feel about the market? And if they show concern or worry, then what you need to do is make sure that you sit back a little bit and hold some cash. And part of the reason is that cash is a great opportunity to have in a portfolio when it's built at a high. So when the market does go down, that cash can be used to help buy your way out of the bottom. Tyler, anything else here as far as reassessing or rebalancing?
Yeah, Dean, when it comes to 2018, where we're at now with the market, and we've talked about this before, but a big thing is to look to rebalance your portfolio. So if you have a 401k and you're 3 to 5 years away from retirement, you might have a moderate allocation, meaning you have about 60% stocks for growth potential and then 40% bond positions, which are used for safety, stability, preservation. They're not going to do much. They're not going to give you much upside, but they're also not going to take the big swings downside like stocks do. So again, 60-40 mix, you might have that. But if we have a couple years like 2016 and 2017, where you originally were in a 60-40 mix, over time your stocks are going to grow more than your bonds. So now you might be 80-20. And here, if we have a market downturn, you're going to be more susceptible to loss. So if the market drops 10%, you might go down 8% as opposed to 5 or 6% if you're not rebalanced correctly. So by rebalancing, you're not only taking gains off the table and shifting them to a more conservative position, but you're also protecting from large losses that you may not be accustomed to or might not be prepared for. So reassess your stock and bond mix. And with that said, most retirees favor downside protection over upside gain. And what I mean by that is, let's say the market gained 10% in any given year, and if their portfolio gained 8%, most people would be pretty satisfied. Some may not be, but a lot of retirees would be pretty satisfied with that. However, if the market dropped 10% in any given year and their portfolio is down 8%, they wouldn't be too happy. And there's actually surveys done on that they would rather protect on the downside than pick up gain on the upside. So instead of, if the market was down 10% and they were down 8%, they'd rather be down closer to 2 to 4% instead of 8%, but then not get that full 10% on the upside. So that comes with risk managing and reassessing where you're at in terms of your stock and bond mix. And that's the number one thing that people should do now that we got into early 2018 and we've seen a little bit of volatility here.
Okay, before we go on to the next topic, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, what we're going to talk about now is we would like investors to pay attention to various economic indicators that can affect your portfolio. Tyler and I and all investment advisors need to stay in tune to what's happening in the market. we also need to stay very much in tune to what's happening with our economy. And right now, the markets are driven quite heavily, both up and down, with economic indicators that are out there, and also some events that are happening. So, for instance, the main two items that we are going to see this year is continued tax reform, and we're also going to see supposedly an infrastructure rebuild plan. So if we look back at the end of 2017, the market took off and stayed very favorable based on tax reform. But as analysts say, that was built in. And what we mean by that is, even though tax reform didn't really get signed into law until, I believe, December, the market took off after everybody started talking about tax reform, and it looks like it was going to be signed into law. So it was built into the market. Towards the fourth quarter of last year, the market continued straight up. The first quarter of this year, a lot really wasn't in place yet for tax reform, but the market was still favorable with that. Having said that, we are now just starting to see some of the results of tax reform. You hear in the news that a lot of companies are giving one-time bonuses to their employees, or they're increasing minimum wage. Those are some very favorable things that are helping stimulate the economy. People are buying more, hence, stocks are going up. At the same time, though, we really haven't seen some of the numbers come back from some of these large publicly held companies yet until right now, which is earnings season. So in April, we're starting to see some favorable numbers coming back. Analysts are saying that this could be one of the most favorable earning seasons in the history of the stock market. I mean, that's pretty profound, and that's important. So we're looking at earnings right now. There's also a term called repatriation of tax dollars. And what that means is these companies now that have stock, these publicly held companies and private companies, are starting to see some of their dollars come back from overseas because they have favorable tax rates now. And that is going to lead to more investing from these companies. And again, you're hearing on the news that some companies are, building, 14, 15, 16 billion dollar additions and new plants and so on here in the United States because of the tax reform law. So it's important to know about tax reform, how it could continue to push our market favorably. Tyler, anything else about tax reform before we talk about infrastructure rebuild?
Yeah, Dean, in terms of tax reform, for the first quarter of 2018, so that was from January through the end of March, the growth rate for the S&P 500 was 17.3%. So the market didn't grow by 17.3%, but the companies within the S&P 500, their earnings grew by 17.3%, which would mark the highest single quarter growth rate since quarter one of 2011, and that was primarily driven by tax reform. So the tax reform bill that was passed in December of 2017, we're already seeing the effects of that, what that has on different companies, different stocks. What's happening is they're saving tax money, so that's going into the business, going back into the business to grow the company. They're not paying as much in taxes. They're growing the company through research and development, through their employees, one-time bonuses, upping their wages, a bunch of different things like that. And that's being reflected in the earnings, which then drives their stock prices upward. So again, with tax reform, we're already seeing the effects of that in early 2018. And one other thing that I wanted to mention is the tax reform bill will especially help smaller companies, which they pay higher taxes right now relative to the large multinational companies. So in our client portfolios, we always want to make sure that we have at least a portion within different small cap funds, simply being we see those growing due to the tax reform bill and then continuing to grow under the Trump administration with different regulatory reform that he wants to try and take off a lot of restrictions, financial restrictions on smaller companies. So really the main thing, tax reform, we're already seeing it in 2018, but continue to pay attention to that as we get into the summer and fall months here, because that could continue to drive the market is tax reform.
Okay, and in addition to tax reform, we said we're going to talk about infrastructure rebuild. Now, this hasn't happened yet. We're in April of 2018, but what is proposed is an infrastructure rebuild plan where here in the United States, for the first time in almost 25 years, there's going to be a major push to rebuild bridges, airports, roads, things that we haven't seen, like I said, in 20, 25 years. If that does go in place, people have to understand how that could really spur not only the economy, adding new jobs for people that have to be hired to do these jobs in the infrastructure rebuild, but those companies who are also invested in machinery that would have to be purchased and used for the infrastructure rebuild. So I tell people this could be a very heavily slanted, U.S. initiative. And what I mean by that is almost all the labor is going to be domestic U.S. labor because it's a U.S. initiative. Also, a lot of the companies that are going to be providing the goods, services, and the equipment, many of them are U.S. backed. I mean, we see a lot of industrial type stock positions that could possibly move here. And for instance, like Cummins and Caterpillar and John Deere and Pierce. So again, coming off of tax reform, going right into an infrastructure rebuild could really stimulate the economy. Hence, a lot of these stocks would continue to grow. Tyler, am I missing anything when it comes to the infrastructure rebuild?
No, Dean, I think you covered everything there pretty well. One other economic indicator, though, that I wanted to give our listeners some input on would be the international economy. That's one that we've talked about it quite frequently on our show, but in 2018 now, believe it or not, despite everything that you hear in the media, on the news, you hear things about Russia, Syria, North Korea, the Middle East. Despite all that, the international economy is as strong as it's been since 2007. So that's the other place that we want to look. You might want to consider positioning a portion of your portfolio internationally, just because the international market has grown 20 to 30% over the last year, and we foresee that continuing on over the next few years to come here. But then in addition to that is emerging markets. So emerging markets are economies that are growing. They're not considered fully developed yet. They're still, hence the term emerging, they're still emerging markets. And a lot of those can be found in Central and South America, where there's a lot of emerging markets, and those are up, 30 to 40% over the last year. So that's another portion that you may want to have some of your investments positioned in as international and emerging markets, and continue to watch out for that in 2018 and years to come, because right now that could be where there's more growth potential than the U.S. market. So I think that you'd probably be doing yourself a disservice if you don't have at least a portion of your portfolio, as little as 5 to 10%, in international and emerging market stocks.
Okay. One other thing, just in summary, we talked about 2018. We still believe it's going to be a favorable year. However, there's going to be more volatility than we're used to. Having said that, now is a good time to really pay attention to your fees. When the market is going up in 2017, most people neglected the fees, and I'm talking both internally and with your investment advisor, okay? So fees were typically neglected because people were very, very happy with their returns. When you start to go into a sideways market, which we've been in here in 2018, we had a wonderful January, and then we had February, March, and April with some volatility where we're bouncing around up and down, and the market is pretty much going sideways. That is a time where people really look at their statements and they say, well, if the market's up a little bit and I'm down a little bit, that doesn't sound right. That's typically because the internal fees and or the advisory fees you're paying. So now is the time to go and look at, efficient portfolios when it comes to your fees. Ask your advisor, what your fees are. The more efficient your portfolio is, the more gain you're going to have in your pocket. So the reduction of fees also takes the pressure off of you as an investor, because you don't have to take as much risk to get the reward. In other words, to get a gain if you reduce some of those fees. And if you have internal fees or heavy advisory fees, you will probably have to take more risk to pick up more growth to offset those fees to add more to your bottom line. Tyler, anything else on the fees?
Yeah, Dean, really with fees, as you said, they can really show themselves in a sideways market, which is what we might see in 2018. But it's important to note that all investments have fees. There's really no way of getting around that. It's just making sure that you understand what you're paying in fees and you know what you're getting out of them. For example, we've seen clients that have had different types of investments that might have internal fees of 3 to 4% per year. Well, when there's a flat market, and you're not able to net 3 to 4% per year just to break even, you're really going to see the effect that fees have on your portfolio. And then even if the market's down 2% for a given year, you might be down 5% because the market's down 2% and then you're down another 3% for the investment fees. So fees can really show themselves in a sideways market. Make sure that you know what you're paying for the fees, and all types of investments have different fees. For example, stocks have a one-time commission when you buy into it. There's no management fee. Exchange traded funds, they have different internal fees. They're usually pretty cheap. And then mutual funds have internal fees for the mutual fund managers to buy and sell off the different stocks or bonds in the fund to manage it. And then with that, the different types of investment classes have different fees as well. For example, large cap stock funds usually have lower fees than mid or small cap stock funds because the managers have to do more research, because small and mid cap stocks, smaller companies, they're harder to research on than the big, the Johnson & Johnson, Home Depot, Walmart, McDonald's, Apple. And then even more fees than mid and small cap are usually international and emerging markets. Reason being is that the mutual fund managers, they have to go and do more extensive research in the international and emerging markets to try and find which stocks to pick and put in the portfolio. So really, there's different fees based on the type of investment, different fees based on the asset class. So again, large cap, mid cap, small cap, international. And then also over the course of 20 plus years, your fees can really add up over time. And it's important to know, again, just important to know what you're paying in fees and pay attention to them, especially if we might have a sideways market in 2018. But ultimately, it is nice to choose low-cost fees, but you don't just want to choose an investment solely based on the fees or lack thereof. And although past performance doesn't indicate future results, it's important to look at funds that have had a long track record of quality performance net of those fees. So ultimately, pay attention to fees. They really show themselves when the market's sideways, kind of what we've had so far in 2018. A lot of people can really see the fees in their portfolio because, again, in 2017, when the market's doing so well, a lot of people, they're not going to be paying attention to that. They're not going to realize that too much because things are fine and dandy. Sure, they're paying fees and they know it, but as long as they're making money, it doesn't matter. But now, when the market gets a little bit shaky, fees can really come out. So again, pay attention to that in 2018 and moving forward, and just make sure that you have a portfolio that is positioned correctly and that's efficient over time.
Okay, that's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.